Good morning. You are watching a live daily market outlook for Friday, 23rd of March 2012, prepared by Windsor Brokers. Most of the markets were rather neutral and quiet during the Asian session, with some more action seen this morning after opening of Europe as the dollar was lower across the board, with the major currencies appreciating against the near-term weakness of the US dollar, as euro and sterling bounced to their fresh day highs and threatening some important resistances to be taken out. The growth-linked currencies, as mentioned, they edged higher following a sharp sell-off yesterday on weak data of the Eurozone and China, and the immediate threat of further weakness is now away as the currencies bounced higher. The main dispute between the Fed dovish and the hawkish wings is about the current recovery of U.S. economy. That was so far giving quite good signals, but the gap between the Fed's doves and hawks was on display, as yesterday the top Fed official said the economy is in better shape, even as Fed Chairman Bernanke focused on a source of weakness. While growing slower than we would like, the U.S. economy is expanding fast enough that it does not need further help from the central bank. Dallas Fed President Richard Fisher said in an interview yesterday. Also, he added that we will not support further quantitative easing under these circumstances because there is a lot of money lying on the sidelines and lying fallow, he said, according to a transcript provided by the network. From the other side, the Bernanke sounds more cautious, saying U.S. consumer spending is still too weak to ensure a healthy pace of economic growth. He said right now, in terms of debt and consumption, we are still way low relative to the pattern before the crisis. He said yesterday in his lectures to students in the George Washington University. Fisher is in the minority at the Fed, which last week reiterated its expectation that it will need to keep short-term interest rates near zero through late 2014 to help lackluster recovery. But his vocal opposition to further easing points to the challenges Bernanke faces as he seeks consensus on future policy in the face of subpar growth and high unemployment. While Fisher does not have a policy vote this year, he participates in the Fed's regular policy meetings. In response to the deepest recession in generations, the Fed, under Bernanke's leadership, slashed short-term borrowing costs to zero and promised to leave them there until at least late 2014. The central bank has also sharply expanded its balance sheet through the purchase of some 2.3 trillion in treasury bonds and mortgage-backed debt. From the other side, negative data from Europe continued overnight from UK, as the British consumer moral eased in the last month from January's 5-month high, as shoppers grew more worried about their jobs. A survey from Building Society nationwide showed in the early hours of today. The figures came with the February retail sales data released yesterday, which showed the biggest monthly drop in sales volumes for 9 months and raised concerns about the health of Britain's sluggish economic recovery. The nationwide said its consumer confidence index dropped to 44 in February from 47 in January, more than 30 points below its long-run average, though it holds above the record lows seen in the final quarter of 2011. The fall was broad-based, with the deterioration in consumers' assessment of the present economic situation, the future, and their willingness to spend. From the other releases due today. Not a very big calendar as it's end of the week. The Swiss National Bank quarterly bulletin is due in at 8:30 GMT. Italian retail sales at 11 o'clock. Some improvement is expected despite yesterday's negative retail sales from UK. While across the ocean, Canada starts at 11 o'clock GMT with its inflation. CPI monthly for February is forecasted at 0.4%, unchanged from the previous release, while core CPI is expected to tick higher by 0.3% compared to 0.2% of the previous month. From US, new home sales are due at 1400 GMT, and the improvement, the forecast for today is slightly better from the previous one, increase to 326,000 units is forecasted for today compared to 321,000 of the previous month. Speakers from US, Fed Bernanke is due at 17:45 GMT, and also FOMC member Lockhart is due to speak at 19:30 GMT, and that would be all for today's events and economic indicators that are on the calendar for Friday. We are going to take a look now in the markets and see the latest movements of the majors and the commodities. As we see, the euro was in the near-term downtrend of 21st of March high at 132.83. That dipped down to 131.32, marking approximately 50% of the latest rally from 130.00 that peaked at 132.83, just short of our upside targets at 132.90, high of 8th of March, and the 133.00 Fibonacci retracement, 61.8% of the broader downtrend of 134.85 to 130.00. The easing of yesterday, 2 days ago, high at 132.83, found support at 131.32. Just ahead of our next strong support at 131 zone, where is also 61.8 Fibonacci retracement, and a steady bounce higher was initially capped during the Asian session at levels just above 132.00, with more action seen this morning as the single currency rallied towards next significant resistance at 132.53, yesterday's high. That was nearly tested 132.49 we saw so far, but the improvement in the hourly structure sees now potential of possible attack and break through this level. This is required to confirm the bottom at 131.32 and refocus upside levels high of 32.83 of 21st of March and 132.90, 133.00. This is our key barrier in the near term, and the break above these levels is required to resume the short-term recovery of 130.00 and open higher levels for a test. Also break above 61.8 Fibonacci retracement is a good signal for a further extension higher. On the downside, daily studies are now attempting, let's say, through their midlines to break above. We need to see clear break above 133.00 to confirm this action, as the downside is for now protected at yesterday's low at 131.32, where is also 90 days simple moving average on the daily chart. More lower time frames, supports and resistances, 131.89 is 132.00, 131.89 is the initial support, while any break below yesterday's low at 131.32 would further weaken the structure. Risk is now seen whether break of 132.50 will occur. That will refocus the upside, or upside rejection at this level that might risk further easing. However, the positive near-term studies see potential and are more supportive for the further upside action. Approximately similar situation on the cable, as it dipped yesterday on disappointing data to 157.69. Basically followed the euro, and this was also around 50% retracement of the 156 to 159.22 rally. 157.69 was the low. What was significant that the pair again broke below 200 days moving average, marking possible recent break as false. However, this morning's price action returned back above the 200 days simple moving average, currently hovering around there. We need to see clear break above this and possibly weekly close today above this level to confirm a more positive structure and possibly refocus 160 zone for a test. Meantime, clearance of 159.13.22 previous highs, the recent highs, is required to confirm this. On the near-term outlook, the hourly studies are regained some momentum on the latest strength, but still short of initial strong barrier at 158.91 as the pair reached 158.80 so far. Risk again is seen on the failure here. That might signal a lower top and fresh leg lower. Initial support at 158 zone, and the other one is yesterday's low at 157.69, loss of which to open way for more significant reversal of 159.22. That will, in case of further break lower, stay intact and might risk confirmation of the lower top against 159.91, the previous top posted on 29th of February 2012. A loss of, on the downside, loss of 50% retracement at 157.62 is to confirm the negative near-term structure and the open way for further easing. 157.45 previous highs and 157.24, 61.8% retracement are on the downside, while break above, as mentioned, above 158.91 is now required to refocus levels above 159.00. The dollar yen extended its reversal through the key support at 83.00. That was the recent range floor, and this now might signal risk of stronger correction of the broader strong uptrend from 76 base that so far peaked at 84.17 on 15th of March. More significant is current daily situation on the daily studies that started pointing lower. That might be a good signal of stronger recovery, of stronger correction. So far, the pair retraced 23.6% of the entire move from 76 to 84.17, hitting a fresh low at 82.31, with more significant losses seen on a break of next barrier at 82.00 that marks 61.8% retracement of the latest upleg from 80.55 higher base to 84.17. The latest low is just below 50% retracement, while loss of static support at 82.00 low of 13th of March 2012, and also 61.8 Fibonacci retracement, is to confirm the pair in the corrective mode and the open way towards next levels 81.45, 81.00, and the possible extension down towards 80.58 seen on a break. The dollar Swiss failure of a corrective bounce of the latest low at 90.75 posted 2 days ago, that the recovery failed at 91.77, that marks 38.2% retracement of the latest down move from 93.33 peak of 15th of March that bottomed at 90.75 2 days ago. So far, the structure on the hourly chart and turned negative as the latest slide seen in early hours of this morning. Tested so far the initial support at 91.00, 90.94 was seen so far, turning immediate risk down towards strong support at 90.75 and 90.69. This is the higher base of the latest rally from 89.33 double bottom, and the loss of these levels is expected to open way for further easing of 93.33 and open next supports at 91.20, 91.00. For now, only break above yesterday's high at 91.75, which is also the 38.2% Fibonacci retracement, is required to avert immediate downside risk and open way for a stronger recovery. Otherwise, the downside remains in focus, and a set break below strong support at 90.75, 90.69 to open way for further easing of the pair. The gold remains under pressure despite the recent recovery attempt, as yesterday's fresh weakness broke below the previous low at 16.34 posted on 14th of March, extending losses so far to 16.28. The negative structure on the near-term studies continues to pressure the price of gold, as 20 days moving average in past week capped all recovery attempts, and so far is keeping the current recovery limited at 16.40, just a few ticks. The price is currently just few ticks below this level, as negative studies see potential of further easing of the yellow metal. Daily structure is also in the negative territory, and sees potential, of course, for a further easing, as it lost 200 days moving average on the recent slide of 1790 high of 29th of February, and tested so far 61.8% retracement of the latest uplift from 1522 to 1790. Break below this level opens 1604 and 1600 as a round figure support, while only a regain of levels at wait a minute, the initial resistance at 1669 to ease the bear pressure, while break above 1700 and 1716 is required to turn the focus higher. For now, the strong pressure remains at the downside on gold. A quick look at crude oil, that still remains within the range, but the tone is slightly turned towards the downside, despite the still positive structure on the daily chart show that the price still remains in the uptrend, and this current range is seen as consolidative. However, yesterday's action lower put under pressure the range low at 104.29, as the price hit 104.50 so far. 4 hour and 1 hour studies are still negative, despite the latest bounce of 104.50 that hit so far 105.87 high, but still holding under 55 days exponential moving average on hourly chart at 106.00. For any stronger improvement, we need to see the break above 2 days ago high at 107.62 to possibly refocus the upside ceiling at 108.30 2030 and 108.68 high of 19th of December, 19th of March 2012. On the downside, immediate support at 105.40 ahead of 105 round figure support, and more significant 104.50 and 104.34, loss of which is would be quite risky for the pair, as this would signal the break of the current consolidative range and immediate attack at 103.87, where is the main bull trend line, as well as previous range ceiling at 103.72. That might risk further easing of the oil price of the recent peak at 110.53 posted on 1st of March 2012. Have a nice day.